a higher resting heart rate for inflation, which has implications for asset allocation in a traditional portfolio. Joining us now, the CIO of KKR's $28 billion balance sheet, Henry McVey. Henry, also a partner at KKR, head of global macro. Great to see you, Henry.
It's great to be here. How are we doing?
You know, last couple of days, we're kind of in suspense on the CPI number, the PPI number, and to me, it's all about the bond market decides if this is okay or not, right? And so we've been kind of fixated on every basis point in the Treasury market for what that's going to mean for equities. You're focused on this relationship. How do you see it?
A couple thoughts. One, I would say, is the services inflation is going to stay stickier for longer. So you have had goods inflation come down, but when you think about the direct correlation between wages and inflation, that's the place to focus. And I think our thesis that we've laid out for quite some time has been this higher resting heart rate. And so we've really shifted our own capital. So as you mentioned, our $28 billion balance sheet, we've moved from about 18% real assets to 25%. So what does that mean? That's real estate credit, infrastructure, climate, those type of things that actually benefit from contracted revenues, where if inflation moves up, your revenues move up too. And that's a big change from what the last 10 years, get long growth, get long duration and fixed income. This is a different playbook. And so that's where we're positioned.
So the premise, in part at least, is that bonds will not offer the same kind of diversification benefit to stocks because stock and bond prices are kind of linked because inflation is the key variable?
Yeah, what's happened, as long as we've been talking, is that, you know, if stocks went down, then bonds rallied, and you always had a shock absorber in your portfolio. That is breaking down. And even though inflation is peaking and coming down, the relationship between stocks and bonds is staying the same. And what I would premise is that, think about banks in the U.S. got about $700 billion of unrealized losses, and the Fed's got about $1.1 trillion of unrealized losses in their bond portfolio. So every time you get a rally in bonds, what are they going to do? They're going to be that overhang. They're going to sell. And then one of the things I picked up in Japan is we talked about this last time, they are exiting deflation. Guess who the biggest owner of U.S. bonds is?
Yeah.
Japan, right? So you've got increased supply. The second force is you've got banks and the Fed with, being underwater on their bond portfolio. And then ultimately you have Japan, where they can now buy more bonds domestically. So that setup means you got to take things differently. And that's what we're trying to do with our clients is reposition. I'd say probably the place where people are most underweight is around infrastructure, asset-based finance, kind of like housing, those type of things, as well as real estate credit.
So those wishing for a 3-handle on the 10-year, you just don't see it.
I don't see it. I think what's going to happen is the Fed and the ECB, they'll probably pause, but we're going to have this higher for longer type thing. And so I think the idea that we get bailed out by rates going down, that doesn't work anymore. Most of the Fed governors and the ECB and the Bank of Japan, they would say in the past they were trying to use QE to kind of really give you a roadmap. Hey, we're going to be very protective of rates going up. Today, they don't have that visibility. Wages, energy transition, geopolitics, and fiscal. One thing we're learning in the United States is from the different regions is there's just more money in the system. It keeps popping up. And I think going into the 24 election, I'm not sure I believe that either political party is really going to want to see us go into a recession.
So year-end 10-year, 4 3/4?
That's where we are. So the market, I think when we've talked in the past, we've talked about the short end being mispriced. We would put forth today that the long end is mispriced. And that's not just a U.S. comment. There are areas around the world where we look at developed markets, and I think there's going to be more upward bias to rates there, too.
It's definitely sticker shock if we get to that number in the short term. But longer term, I mean, we've been talking actually from before this, right?
Yeah.
So from the mid-'90s, really, if you go before 2000, stock prices and bond prices were a little more positively correlated. Yeah. And you had positive real rates for the most part.
Right.
And the real threshold for whether inflation was a big problem for stocks was more like 4%, not 2%.
I totally agree. And by the way, banks have been suffocating under QE.
Yeah.
And so they actually can now make a positive spread. So let's say that the Fed and the ECB end up, easing a little bit on the short end. You get a positive slope. Financials will perform a lot better. And that's where I think we're going to go. I think next year, I heard the interview with Ken Griffin. I would agree. Real rates are going to bite into the economy more than this year. Even though they've been raising rates, real rates rates are just turning positive, that will, hit us. So what we've been saying is a little less boom, less bust in 23. Everybody's been super negative, but maybe less boom in 24 as those real rates take hold. I don't think we should fear 3 to 4%, long bonds or inflation. I just think it's the transition period you got to work through.
Yeah, a little friction. All right, KKR and Citadel on the same side of this one. All right. You heard it here. Thanks, Henry. Appreciate it.
Okay.